While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point.
Yesterday, the Federal Reserve cut interest rates by 25 basis points. The Federal Open Market Committee voted 11-1 for the 1/4 point rate cut. However, it also signaled that 2 more cuts are possible by the end of the year due to concerns over the U.S. labor market. Joining us now is in the studio to discuss the interest rate cuts is Dr. Paul Eisele. He is the Associate Dean of Undergraduate Programs at GVSU. Thanks for being here with us. So, talk about how significant of a cut this is.
Well, it's significant in that it's starting the process. So we knew that sometime this fall they would start cutting rates, and the fact that it's started now tells us that we're going to see several more rate cuts this year, and we're going to see several next year. The bad news about that is they're cutting now because the economy is weakened.
Mm-hmm. I was just going to ask you why they made that decision now. But let's talk about what does this mean for consumers, how the rate cut impacts your mortgage, your credit cards, student debt, auto loans.
Yep. So it's going to reduce those rates, but not by as much as they cut their rates. They're cutting the rate that banks charge each other. And right now we've seen that the cuts for the mortgage rate over the last week have only been about half as much, all right? What we are seeing, though, is the interest that you get on your savings accounts and CDs are dropping a little faster than that.
How do lower interest rates affect the economy?
Yeah, it speeds things up. So what we know right now is particularly the housing market's a little bit frozen, and every 1/4 point you can take off a mortgage rate reduces your monthly payments, and that causes people to buy houses. So that's what they're hoping for right now.
Mm-hmm. And how significant can we expect future cuts to be?
Yeah, I think we expect certainly another ½ point before the end of the year, and probably another full point next year. So by the time we get to summer of next year, we might be looking at 5% mortgage rates.
Okay. So now that there has been a cut, would you advise people to, to buy a home or refinance? Now, some people have been waiting a little bit. Some have been buying, but some have been, waiting because they're waiting for that, drop.
Mm-hmm. Well, the short answer is that you need to figure out what you can afford.
Right.
And once you figured out what you can afford, as those rates drop, you'll find that point where it may fall into the zone that you can do it. Right now, we're seeing the price of houses stay pretty flat, maybe even go down a little bit depending on where you live. And so waiting a little bit right now doesn't hurt you.
Okay. Anything else that you wanted to share that I missed?
No, I think that the markets have been waiting for this, and it's good that we're starting to have some certainty, because now that we have certainty, businesses can do a little more investment, and we might see some of those jobs start to come back.
That'd be good. All right, Dr. Eisele with GVSU, thank you for being here with us.
Thank you.